Hello, aviation operations students. This is video number 2, the second lecture for day 1 of week 8. And we go over tracking of what we need to keep track of our incomes and expenses and profits, things we need to think about. And here we go. All right. One thing I will ask you to keep in mind as we go through here is ethics. I expect your business plan to be ethical. You need to do the right thing for your customer. And as you know, if you're not doing the right thing for your customer, word of mouth will not help your business. Set a fair price for a fair service. And think about these items as you make up your budget. So when you're thinking about profits, some things to think about: cost control. If you don't need it now, put it off. Or if you buy it now, can you do something extra with it? Planning. Plan for your big purchases. Are you going to start leasing another airplane? Are you going to buy a more expensive brand of something to improve the quality? What are you going to do for your big purchases? And you may want to start setting some money aside each month to make sure you have it when you get there. And you need to have some kind of accounting system. It can be paper and pencil. It can be a ledger, or it can be a software program such as Total FBO, QuickBooks, FBO Manager. We've looked at some of those before. But you do need some way to track it. And you also need to figure out, often at first you pay less for a system because you aren't using it as many things. But as time goes on, you find that you want to buy more of the services because it takes less of your time and you have the numbers you need at your fingertips. And don't forget your marketing orientation. Know your customer, give them what they want, provide good service. And remember that in order to sell units, you need to have customers. Think about your market share and review your budget if it isn't going as planned. Kinds of records you need to keep: inventory, fuel logs. And I also tell you that this can help to track maintenance. If you keep your fuel logs and you look at your fuel use per aircraft, that might let you know if an aircraft has a potential issue. It's one of the things that Summit Aviation does. So if an aircraft all of a sudden starts consuming more fuel, they're going to have that taken in and looked at, because you need to get the maintenance done, one, and number two, it will help you save money. Your maintenance logs. If you have a, like an engine rebuild coming up or something like that, you need to set the money aside to do that. Your income and what we call accounts receivable. So those are the things that you are billing people for. Your expenses and your accounts payable. And those are the bills that you have to pay. We're just going to briefly mention financials here. Later in the semester, we will look at that in particular, but you need to start out with your draft budget before you can look at financials. So one of the things we look at is balance sheets. That shows how much money we have. Our profit and loss statement, looking at our gross profit and our net profit. People generally project cash flow at least 90 days. A year is really good to do in your budget, and then making sure that when you're within 90 days of the end of the year that you have projected your next year. So creating an annual budget and tracking your cash flow for at least 90 days really helps you in knowing where you are and planning for the future. Another thing is depreciation practices. That is, when you buy a brand new airplane, a year later, it's no longer a brand new airplane. And you can write some of that off when you do your accounting and your taxes. So I used a website called Corporate Finance Institute to get some information about the most common depreciation. Straight line depreciation is usually used for aircraft. It can extend out to 25 years. It may be less depending on the use of the aircraft. So you take the cost of the aircraft, in this case, $25,000, subtract the salvage value, what you expect to sell it for at the end, and divide it by the useful life. So in the example here, we bought an airplane that cost $25,000. After 8 years, it's not going to be worth anything. So the way we do this is $25,000 minus any salvage value, which likely you would have with an aircraft, divided by the 8 years means I'm going to depreciate the aircraft $3,125 per year. So I start out with $25,000. The next year it's worth $21,875, and so on until at the end of the 8th year, I have depreciated the entire value of the aircraft. Again, while this is the most commonly used for aircraft, there are others, and it may depend on if you're doing manufacturing or other things, or for example, if you have a computer, 3 years might be the useful life for that. So if you need to run it down faster and take your big cuts at the beginning, they have something called double declining balance depreciation. So you took that value again, but you multiply it by 2. In this case, that gives you 25%. So I'm going to take 25% the first year. Then I'm going to take 25% of that value the second year, and so on and so forth until I get down to the end, and that's going to give me my $2,500 salvage value left. Another is units of method. So you may buy a machine that makes so many units of production, or the same time you can look at, for example, an aircraft engine. It's going to do so many hours of flight. And so you look at the units and its useful life over the years. And in this case, we come out that per unit that we make, it's going to be $1,000 a year that we depreciate. So for example, so the first year we're going to make 4 million units, and the machine life is 100 million units. So that is $1,000 in that first year. The second year we're going to make 7 million units. So I'm going to depreciate $1,750. So in the years that I make more units, I'm depreciating more. The years I'm making less, and especially if you have a business that ramps up, that may work well, or a business that's seasonal. Sum of the year's digits. Sounds a little crazy, but this is something you can do, is you add up the sum of years. So 8 years is 8 plus 7 plus 6 plus 5 plus 4 plus 3 plus 2 plus 1 is a total of 36 years. So year 1, it has 8 of the 36 years left. Multiply that by 25,000 means the first year, I'm going to depreciate $5,556. The second year, it only has 7 of 36 units. And so I'm going to depreciate it by 4,861. And by the 8th year, there's nothing left. So next, we're going to look at sales forecasting, and I will tell you there are very many ways of doing it. I'm not going to go into each of them. You have to think about your business, what you need to do to make a profit, and also what you think is realistic given the current market. So in sales, you're looking at goods and services. You are selling X amount of goods and services, and you are taking in the money for them, and you are paying expenses to provide those goods and services. Your revenues, you can look at per unit. How many units? So you're looking at, I am going to sell, in my case, I am going to sell 5 of each book per month, and I'm going to make a $5 profit per book. Expenses, you have both your fixed and variable expenses, and your variable expenses should be pegged to those units above and updated as that goes on. So again, examples of fixed expenses, often called overhead, that is the cost for your business being open. It is not necessary. So if you're open, that's it. You pay this. It doesn't matter whether you have customers or not. Rent, utilities, unless utility is one of your variable expenses. Property taxes, office supplies, labor, professional dues and publications, janitorial maintenance, advertising, inventory, insurance, telephone and internet access. So those are some of the things that are your fixed expenses that you're going to budget a certain amount every month. You may change it seasonally, but it's going to have an amount that is for each month. So how do you improve your cash position? You look at your business and you really want to make this happen, but how are you going to get this off the ground? One way is to ask family and friends. Exactly how many cousins do you have? But you want to make sure the agreement is in writing so that you have a good relationship, that if you're going to pay them back every month, are you going to pay them back annually? Are you going to pay them a percentage of the profits? Are you going to pay them back the money they paid you plus a percentage? Make sure that when you borrow money from someone, you have an agreement in writing on how it is to be paid back. While in Montana, a handshake does make for a legal agreement, it really does help to have that in writing to make sure there's no misunderstandings and bad feelings. Accounts receivable financing, and that is a loan against money owed to you. And many businesses do this because they have a whole bunch of money that's going to be coming in, but they need that money on the first of the month to pay rent and pay payroll. So someone actually gives you a loan. They buy the money owed to you, and you pay that money back with interest. Leasing. Don't buy that airplane, lease that airplane. Don't buy that computer, lease that computer. Venture capital. There are venture capitalists out there who will invest in businesses that they find interesting. And there are also small business loans through the Small Business Administration. And right now with COVID, there are also some small business loans available that way if you already started. Customers. Can you get your customer to buy blocks of flight time or lessons, to pay you in advance for services? But remember that you still owe that service or you owe the money back. So while this is good to have money in the bank and keep a positive balance, you do not want to spend this money, because if you go bankrupt, you will owe this money. With banks, once you get up and running, you can have a secured line of credit, or maybe if you do own aircraft, you can have it secured against the aircraft or the hangar that you own. Going public is another way to get investors, but you need to be pretty big for that to happen. And there are small business investment companies licensed by the Small Business Administration to provide equity capital or long-term loans to get companies up and running. Because again, those small businesses are the engines of our economy. Get cash on the spot. Everything you get, people pay for in cash. Deposits and advances. People can pay you when they have the money, and then you can provide the services later on. For example, if they are going to buy aircraft from you or something, make sure you get larger deposits up front for that transaction that you're handling. Seeking credit cards as a substitute for a banking line of credit, that is not a good idea. You are using credit to pay credit. Usually you end up in a position where you cannot afford to pay your bills. You owe people money, and that is a quick way to bring your business down, because you're going to be paying interest on that line of credit, and it's not a very good way to do business. So financing. Think about financing as you're renting the money to run the business. So you have to look at the costs of borrowing the money to being offset by a profit percentage. So if you aren't making a profit, how are you going to pay this money back? Because there is going to be interest on it. So what is it? Do you need 15% to make sure that you don't have to borrow? You may want to look at the end of the year. I need to pay this money back plus interest, and I don't want to have to borrow the money next year. So what kind of profit am I looking for myself to make this business plan come out, so at the beginning of next year, I can launch into the business without having to take out another loan? You know, is that enough for you? Does that pay both the interest and principal? Are you doing something where you're only paying the interest? Again, big businesses seek 15 to 25%. Sometimes a small business, the first year to making a profit is not possible. So you have to make sure you've made arrangements in servicing your debt. Thought I'd add a little humor today, because talking about money can be pretty dry. So again, your break-even analysis. Are you breaking even by the end of the period? Do you have the money needed to launch into the next period? Are you keeping a positive cash flow? Are you making progress paying your investors back? And again, if you're going to pay back a lump sum, consider putting some of the money away each month to make sure you have that money when you need it. The things you need to track: profitability variations among product lines. Do you need to change your price point? Do you need to change to a different line of materials you're using to manufacture something? Do you maybe need to discontinue it because it's just not making money? What are the profit centers that are making sure that you're doing well in your business? And do you have some loss leaders? That's not necessarily a bad thing. Free items or services, if that brings in customers and gets money into the other two areas, that can be positive. So let's take a look again at that draft annual budget. I did make the changes per unit on this. So when you look here at variable expenses, in the first month, I actually wanted to get 5 surplus so that I have a surplus to carry along. And then each month I am buying the documents for the next month. And then times the price that it costs. So again, I'm looking at this. This is where I'm starting. And actually, as I corrected my spreadsheet, it turned out that I had some numbers that were incorrect. So I only have to borrow $2,500 instead of $3,800. As I look at my bottom line, while these first few months I run negative, I'm doing pretty good with my bank balance, because while I'm running it down, part of that is to have more inventory for my big sale month. Again, as I look at the end of the year, wintertime, when there's not as much going on, I don't have quite as, I'm losing money, not a whole bunch, but I may need to look again at, by the time business is starting to slow down, having a second location, because so that as I move into next month, so last year I needed $2,500 to get started. I've only got $1,900. That's not going to be enough to run the business for the next year. So I need to change something here to make that work. So again, this is your draft budget. These are the units that you're selling of something and the price you're selling them for. Here are your fixed, and you can add or delete lines, but you need to make sure that these formulas, so example, this goes from B17 to B21. So if I add some more rows and that's not calculated, you can edit that. If you need some help with editing that, have any challenges with Excel, please feel free to reach out to me. Or if you find Google Docs easier to use, go ahead and use that. You can import this right into Google Docs. Your variable expenses, again, based on units, and then making sure I'm paying back on the loan that I took out from myself. And again, you have your total expenses, your income minus expenses, and basically your bank balance. It goes all the way down to $40 here. That's pretty low, but it's because this is going to be a really big month. So I want to make sure that I am putting money aside to have the inventory I need for these couple big months. So back to our presentation. And again, keeping in mind as you look at that, to make sure that you have a positive cash flow. It's okay if it's negative a little bit, or at the beginning, you have that investment money to get you up off the ground. Sometimes it takes a few months to get things running and to start to get that profit. So next up will be finance number 3, looking specifically at budgeting and income. And that is the end of the presentation. Thank you very much.